And now for something completely different. I'm a big fan of Monty Python's Flying Circus, and we today are going to engage in some silliness that would make them proud. No, we're not going to be discussing a dead parrot or singing the praises of spam in the breakfast table, but we are going to be discussing technical analysis, reading squiggles on a screen. And you know what, folks? I'm really not the best person to introduce you to this topic because I think it's all hogwash. But there are others who swear by it. And so you need to seek them out to find what they believe is the reason why you should study technical analysis. We've done fundamental analysis. We've discussed the efficient market theorists that say fundamental analysis and technical analysis are useless, but we've already seen that they're wrong. And so we'll now spend some time on technical analysis, and I will do my best not to poison the well for you. But I tell you, my bias is right up front. And so someday this will be a collaborative effort because we're giving out the textbook to the entire world, and hopefully one or two or three or more academics, maybe not an academic, but we'll see it and say, I want to rewrite that chapter, Payano. I want you to do a better job about technical analysis, and which I'll say, thank you very much, because I have a hard time keeping a straight face when I discuss these things. Let's start with a quote from John Burr Williams in his book, The Theory of Investment Value, which is actually dates back quite a few years. The fundamental analyst says you are buying companies, not stocks. The technical analyst says you are buying stocks, not companies. So I side with the fundamental analyst. And it has nothing to do with fundamentalism religion, folks. It just means people who believe that you are buying a business, you're buying a company, and the stock is just the vehicle. Whereas the technical analysts say, no. You're following the stock. You don't care about the company. You want to know what the stock or the stock market or both are going to do based on what they've done in the past. Let's get started on slide number 2. And to review, fundamental analysis, what we did in chapters 4 and 5, is the in-depth study of the financial condition and operating results of a firm. We learned various methods for evaluating the securities by attempting to measure the intrinsic value. What is it worth? Fundamental analysts study everything from the overall economy, the industry conditions, the financial condition, the management of the company, all the things that we've been discussing. Simply put, the value of a stock is influenced by the performance of the company that issued the stock. The valuation models from Chapter 4, the ratio analysis, the financial statements in Chapter 5, those are examples of fundamental analysis techniques, and there are many, many others. So, to review, what are some of the fundamentals? The competitive position. Who is it? Is it a Visa or a MasterCard or a Discover card, right? Is it a FedEx or UPS or maybe a DHL? What are the composition, the growth in sales and earnings and possibly dividends? What are the profit margins? What are the dynamics of the earnings? What assets are available? The composition and liquidity of corporate resources. What's the capital structure? How much debt? How much equity? What's the capitalization? Large cap, mid cap, small cap, mega cap, or micro cap? Many others that we've already looked at. But there are many investors, we should call them speculators, traders, who don't follow the fundamentals. They use technical analysis, the study of various forces at work in the marketplace and their effect on stock prices or the stock market as a whole. Those who adhere to technical analysis believe that they can predict the future price of a stock by analyzing the behavior of the stock price's history and or the overall stock market. And they use any one or many of dozens of so-called technical indicators. We'll just look at a few superficially. Simply put, the price of a stock is influenced by factors other than the company's fundamental future outlook. And obviously there's a spectrum, right? There are some people who just do fundamental analysis and some people just do technical analysis. But then there's a whole lot of people who mix and match and are on some, maybe 50-50, 70-30, whatever. I'm personally, as I said, I believe in fundamental analysis. So there you go. So let's continue now. What's the argument in favor of technical analysis? Well, stock prices do tend to move in tandem to the stock market as a whole. When the market is rising, most stocks rise with it. When the market is falling, most stocks are brought down with it. There's a very famous saying, a rising tide lifts all boats. There's also a saying that you don't hear too much. Actually, I heard it from none other than Warren Buffett. When the tide goes out, you can see who was swimming naked. But the rebuttal to this argument is that that's just supply and demand at work. When stocks are in favor, prices rise. When stocks are out of favor, prices fall. Repeat after me. There has never been a reliable methodology for predicting the short-term behavior of the stock market. Look, folks, there are many unreliable methodologies that people will do their best to sell you for outrageous sums of money. But nobody's been able to do it in the short term. One company in the 1990s was generally regarded as doing it, long-term capital management, and then they almost brought down the market as a whole. And it reads, if you watch there's a PBS Frontline, or is it Nova, called The $1 Trillion Bet. The $1 Trillion Bet. And there's a wonderful book, When Genius Fails, that discussed what happened with long-term capital management. And when you read Genius Fails, you have the benefit of living through the great financial, the Great Recession, the global financial crisis. And it reads like a prequel, like The Hobbit before The Lord of the Rings, because the same thing happened, but just dozens of companies were doing the same thing in 2006 and 7 and 8. Oh boy. So, what are some of the tools of technical analysis? Slide number 6. Well, there are many tools, many technical indicators. We're just going to look at a few. One of the favorite sayings is the trend is your friend, the momentum trading. They just follow, hey, if the stocks are going up, you go up with them. If they're going down, you go down with them. That's shorting, and we'll discuss it at the end of the semester. Don't do it. It's very dangerous. There are these various support levels and resistance levels. Support levels are prices or levels below which a stock or the market as a whole is unlikely to fall until it does. That's called a breakout to the downside. And then there's the resistance levels that are prices or levels of which a stock or market as a whole is unlikely to rise until it does, and then that's called a breakout to the upside. There are psychological barriers, $100 for a stock, maybe $40,000 for the down now, $5,000 for the Standard & Poor's 500. Why is that? Why is that? I don't know. I didn't make this stuff up. And then the moving average, very popular moving average. You take the last 50 days or 15 days or 200 days, and you calculate the average. And then the next day, you do it again. And then the next day you do it again. And you watch as these moving averages interact with one another. The 50-day and the 200-day is very popular. The 15-day and the 50-day are popular, but you can do 10 and 20 days, and some people do, just a few days, depending on their time horizon. So what we're going to do is we're going to take a look at a couple of these videos. But now, folks, there are thousands of these things. But what I want you to see is that these people are not interested in the company. They don't care about the markets. They don't. I mean the products. They don't care about the markets in which they do business, their customers, their competitors. They're just looking at the stock price history and what these indicators, these moving averages, and these, they call them Bollinger Bands. I still don't know what the hell they are. And then other things that you're going to see in this video. Oops, we're not going to show you this video right now because it doesn't seem to be playing well with Camtasia, the program I use to record these. So you're going to need to click on those videos, and you don't have to use those. Just type in technical analysis learning video or just technical analysis video into any search engine or any video website, and you will see dozens and thousands of these things. And what you're going to see is that the person doing the analysis doesn't care about the company. They don't care about the company. All they care about is what's going on with the stock price and what's going to happen in the next 2, 3, 4 days or weeks, not 3 or 4 years as what we've been, our time frame that we've been using. And that's their strategy. And I wish them a lot of luck. They're going to need it, right? Because as we have learned, the stock market in the short term has already been statistically shown to be random. In the long term, no. In the long term, as the it sounds like an ad, my apologies, but as the level of the economy rises, as we say, the pie gets bigger, as the standard of living increases, the stock market goes up because that's what it's based on, right? The companies that are providing the goods and services that we need to survive. So you decide. You watch these videos and see what you think. So let's continue now and take a look at some of the tools in detail. Come on, got to be nice to your computer. Go there. This is an example of the resistance and the support levels. So supposedly somebody decided, here's the support level, even though it goes below the support level a few times. And here's the resistance level, even though it goes above the resistance level. So why isn't this the resistance level? I don't know. And how come this isn't the support level and this isn't the resistance level? Oh no, because that was a few weeks ago and we're not interested in that anymore. That was a few months ago. We're only interested in this little piece right here because we're going to find out when it breaks out to the upside or when it breaks to the downside, and we have to decide when that's going to happen. And here's an example of where it actually did happen. Here's the support level, supposedly. Here's the resistance level, supposedly. And then, boom, it broke out to the downside. If it breaks out to the upside, well, obviously that's good for us. If it breaks to the downside, that's why they like to have what are called stops. We talked about this transactions. The traders will put a stop here so that they'll only lose a certain amount of money. Great, guaranteed loss. That's what I like. And they say, but that's okay because I could have gone to the upside. Yeah, if the market doesn't go up or down, it'll go sideways. So you can see I'm not a big fan of these things. I want to know, tell me what the company's going to do in 3 to 5, 6 years, not 3, 4, 5 weeks or 3, 4, 5 days. And then here's the moving average, right? Here the blue, I guess it's kind of blue, right? Is the daily price. And you see it's very volatile. So what we did is we created a 50-day moving average, which is this brown line. Notice it's smoother. And then the sort of purple here is the 200-day moving average. It goes back 200 days. And notice that's even smoother than the 50-day. So we're smoothing out. Some people use the 15-day of the 50-day, especially if they want to trade in the short term. And so what happens? When the 50-day goes below or above the 200-day, that's called a crossover. Some people call it the inflection point. It's called a cross. And when it goes below the 200-day moving average, they have a special name for that. It's called the death cross. So that's a bad sign, right? It goes below the 50-day goes below the 200-day, or the 15-day goes below the 50-day. And when the 50-day goes above the 200-day moving average, that's called the golden cross. It's supposed to be a bullish signal. You decide. And in fact, the assignment, which is a bonus assignment, you don't have to do it, is to do just this. Just use the moving averages, 15-day, 50-day, or 50-day and 200-day moving average. We show you how to do it. There's a video. And you decide if this is something you would want to use. And remembering, this is just one of dozens of technical indicators. Then they use these Bollinger Bands, and I still haven't figured out what they are. And then you could use exponential moving average, and then there's a different moving average. I forget the name of that one. And then there's all these other indicators that you can use, and you can basically go wild with these things and never have to worry about the companies, products, their competitors, their financial statements. Just why bother? Just look at squiggles on a screen. Slide number 10, the Dow Theory. This is one of the more historically popular price movement theories. I've read it. I had someone try to explain it to me. And it seems to me that what they're saying is if the market doesn't go up or down, it will go sideways. And I think they're absolutely right. It goes back to Mr. Charles Dow, who started the Dow Jones Industrial Average and was one of the founders of the Wall Street Journal. The only problem is he died before he published it. So others have moved it forward without the benefit of Mr. Dow's insight. So if you can figure it out, other than if the market doesn't go up or down, it will go sideways, please come explain it to me, because I can't figure it out. Other than if it doesn't go up or down, it will go sideways. Yeah, which I think is right. In fact, 100 years ago, over 100 years ago, someone asked J.P. Morgan, John Pierpont Morgan, Mr. Morgan, what's the market going to do? And he said, the market will fluctuate. I knew that. Well, then why'd you ask me? People will sometimes ask me, what do you think the market's going to do, Frank? I say, well, it'll go up and down. And they say, well, I knew that. I said, yeah, I knew that too. So why'd you ask me? Slide number 11, the relative strength. The measure of the performance of one investment relative to another, a competitor, or to the market as a whole. Now, Value Line is big on this, and so is another publication called Investors Business Daily. So you check it out, see what you think about the relative strength indicator. The market volume, how many shares are trading hands, whether of a stock, an individual stock, or the market as a whole. Because heavy volume with prices rising is supposed to be good, and low volume with prices falling, well, that's okay. It's okay. That's good. It's okay. The price is falling, but it's only low volume. But if it's heavy volume with prices falling, well, hey, that's bad. And if it's low volume with prices rising, well, that's bad too. At least that's what they tell me. I don't believe them, but you decide whether you believe them or not. And then the breadth of the market, not the respiration of the market, but the advanced decline ratio. How many stocks went up? How many went down? When the mood of investors is bullish, the advanced decline ratio should rise. Advancing issues should outnumber declining issues. And when the mood of the investors is bearish, the advanced decline ratio should fall. Declining issues will outnumber advancing issues. At least that's the idea. Whether or not it's actually true or not, the correlation, go back in time, maybe it's correlated, but would it be of any use for a long-term investor? Well, maybe when everybody was zigged this way because the market, the mood of the investors is bearish, supposedly because the advanced decline ratio is falling. You could say, hey, I have this company I'm interested in buying. Hey, and the stock market went down. It's not a bad time to add to my position or buy it. But as a short-term trading vehicle, I wish them a lot of success, since we've already shown that stock prices in the short term are random. And then the tick. Now, what are ticks? Does it remind you of polyticks? Remember, poly means many and ticks are blood-sucking insects. This is the trade-by-trade direction of the market. Is it an uptick, a down tick? What's the opening tick, the closing tick? Is it a bullish tick or bearish tick? And there are publications that will say, oh yes, the closing tick was a bullish, whatever. I forget what's the word? The measure. The measurement is, I think, the number of shares that went up versus the number of shares that went down. So it goes with the advanced decline ratio. And again, for long-term prudent investors, it's day-to-day noise, not important. But to a technical analyst who's thinking about what he's going to or she's going to do tomorrow, maybe that's very important. Slide number 13. Finally, we get to something that can be useful to a long-term investor, at least as far as yours truly is concerned, and that's the short interest. The number of stocks sold short in the market at any given time. Now remember, we're going to discuss short selling at the end of the semester. It is dangerous. You can lose a lot of money quickly. Don't do it. But as a prudent long-term investor who's interested in stocks going up, short sellers want the market to go down. They want the stock to go down. you can use this information. The more stocks are sold short, the more investors believe that market will fall, or that individual stock, if you're just looking at a single stock. For some reason, short sellers are somehow considered more sophisticated and are therefore supposed to know when the market will fall. But here's the cool part for us long-term investors. When the large number of investors sell short, eventually they must buy the shares back. That's how short selling works. We'll go into the details later on. But if you sell a stock short, you can't just walk away like you can when you buy a stock. You can hold a stock for 100 years, But when you sell a stock short, you got to come back and buy it back. And this creates a pent-up demand. So it's like a compressed spring, like pushing down on a spring. The more people sell the stock short, eventually they're going to have to buy it back, and it creates what's called a short squeeze. Prices then rise, and people will, the stock market will have a few really bad days, and people will go, what do you think we should do, Frank? I said, just wait a couple of days. And then sure enough, bingo, it jumps back up. What's happening? The short sellers have to cover their position. It's what it's called, covering their position, which means they buy the shares back, and it creates that spring effect, the short squeeze. So if you're interested in an individual stock, you can look at the short interest, and if you see there's a ton of short interest, that means investors, or traders actually, speculators, are expecting the price to go down. And if you're convinced this is a good long-term buy, that might be a great opportunity for you to get in. But it's also another piece of information to think about. Why are all the investors, why are the traders, the speculators, shorting the stock? Why do they believe the price is going to go down? They may be right, but we'll see. Shorting is dangerous. Don't do it. Peter Lynch says don't do it, and who am I to argue with Peter Lynch, right? Slide number 14. Another technical indicator that is actually maybe useful to us as long-term investors, and that's contrarian opinion. The theory that if people are very optimistic, that is the predictor of falling prices for the market, and if people are very pessimistic, that is a predictor of rising prices. Well, it gets into psychology, right? We should all walk around being as bearish as possible. Oh man, market's going to fall, and then it will make the market rise, right? No, it doesn't work that way. I wish it did. We covered contrarian strategy already, investment strategies. You buy when others are selling, you sell when others are buying. The problem is the market historically has gone up 3 times more often than it goes down. So it's just, as we saw back in chapter 3, it's difficult. Being a contrarian, you have to be patient and wait for blood in the streets. Wait until there's a panic, and it's not easy, right? Fear of missing out is what people use, the young folks, FOMO. They don't want to, well, look, he's getting rich. I want to get rich too. Oh, yeah, right. So the short interest and the contrarian opinion, if we see people being very, very bearish, being very fearful, that's the time to be greedy, right? And so that can be useful to us, but for short-term trading, I don't know that it's that important, and that's something we don't want you to do anyway, right? Of course not. Now, a very dubious technical indicator is on slide 15, and that's odd lot trading. That's the theory based on the idea that small investors tend to buy and sell in odd lots. Remember, an odd lot is less than 100 shares. The best thing to do is the opposite of what small investors are doing, is the basis of the theory. However, the research and data behind this theory are very suspect. Plus, technology has made odd lot trading commonplace. So it used to be that if odd lot trading rises, it supposedly meant that more and more small investors were entering the marketplace. And supposedly small investors are supposedly notorious for getting into the market at the top of a bull market. Again, where did they come up with this data? I don't think they did. I think whoever made this thing just made it up and said that's the way it is. In 1987, the crash of 1987, you go back and look at the data, and it was mostly institutional investors who panicked. in 87, and then everybody else followed them. So again, this is a dubious technical indicator, but we include it to show you what is available out there. There are many others, and hopefully, or maybe you will get involved in this. Not hopefully, I'm sorry. Maybe you'll get involved in technical analysis and come back 3 or 4 years later with your Mercedes-Benz or Tesla and tell me I was all wrong, and I'll say thank you very much. Thank you very much for becoming fabulously wealthy. Now teach others. Okay, the most famous, infamous, celebrated tools of technical analysis include charting, or the different types of charts that are created by the technical analysts. The activity of charting is price behavior and other market information, and then using certain patterns that the charts make to make investment decisions. So there are many different types of charts, the open, high, low, close charts, the candlestick charts. They're basically bar charts that are adapted to stocks and other investments that show you what the opening price was, what the closing price was, what the high and the low, and whether or not it closed higher or lower than the previous day. And then as we saw the resistance and the support levels and the breakout, we saw that. There's the very famous head and shoulders, triangles and wedges. I haven't figured those out at all. Flags and pennants, and then cups and handles. And I hear that reading tea leaves while howling at the full moon works great. And it's almost as good as reading squiggles on a computer screen. And then there are people who trust interpreting the entrails of a chicken. I'm just saying. Slide number 17. Here's a candlestick chart, or the open, high, low, close charts. Here's the high, here's the low, and what it opened at and what it closed at. And notice that this one is a little greenish, right? That means it closed higher than it opened. And then this guy is a little reddish, but in here they're black. It closed lower than it opened. So if the close is higher than the open, that's supposed to be bullish, maybe for tomorrow. If the close is lower than the open, then that's supposed to be bearish. So in the chart at left, first the candlesticks are telling us that the stock price went up because notice they were mostly clear. Here they're green, and we should make them green. And then they turn black because the stock price went down, and then the stock price went up again. So isn't it amazing that it tells you that the stock price can go up or down? Yeah, I think it's pretty amazing. I think these things are just amazing. And so here are a few patterns that technical analysts have come up with over the years. There are more. A dark cloud cover. It did pretty well this day, but that day doesn't look too good. So next day, who knows? But we've already shown that prices in the short term are random, so I wish them a lot of luck. Here's a bearish engulfing pattern, which I guess is pretty bad too. And then harami is supposed to be the worst, although I don't know what it means in Japanese. You decide whether you think this is of any worth to you or not, but I'm just reporting what I'm told to report. And then finally, the infamous head and shoulders. Yeah, this is it, folks. This is supposedly really, really bad. I don't know why, but they tell me it's bad. And doesn't it look like a head and shoulders? There's the head, there's the left shoulder, there's the right shoulder. In fact, this was the only question. When I took the Series 7 500,000 years ago, 1998, this was the only question about technical analysis on the entire exam. I think they've lowered the number of questions, but there were 120 questions in the morning, and then you had an hour for lunch, and then 120 questions in the afternoon. And one question was about technical analysis, and all they asked me was, did I recognize the head and shoulder chart? That was all they asked about technical analysis, because really, what can you ask? It's all just somebody's speculation. But that's what they said. Do you ever heard of the head and shoulders chart? And I said, yes. Okay, good. And then here's a cup and handle, which I thought was kind of silly. There's the cup, and then there's the handle. And that's actually supposed to be a good sign until it isn't. So what do you think about charting, folks? You ready? You ready to I don't think so. And then here's the, still don't understand if flags and pennants are good, but there's a flag and there's a pennant. And flags and pennants are kind of similar, aren't they? But supposedly a flag is good and a pennant is bad, or maybe it's the other way around. And then there's another 50-day moving average with those Bollinger bands. Bollinger bands. And you know what? I still haven't really figured out what the Bollinger bands are supposed to do. But here's a so if it piques your interest, go to Investopedia or just go to any search engine and type Bollinger bands, and you will get millions of hits, and you will get plenty of advertisements for learning how to trade like a king and be rich beyond your wildest dreams. Only burn your credit card for $5,000. Don't worry, you'll pay off that credit card and all the other credit cards that you owe in 2 weeks, in 2 months. Think I could make a lot of money if I didn't have any ethics? I think I probably could. Slide number 22. You too can be a technical analyst. Look, this is a real quote from, it's actually from a random walk down Wall Street. But Professor Burton Malkiel got this quote from a technical analyst. The market's rise after a period of reaccumulation is a bullish sign. Nevertheless, fulcrum characteristics are not yet clearly present, and a resistance area exists 40 points higher in the Dow. So it is clearly premature to say the next leg of the bull market is up. If, in the coming weeks, a test of the lows holds and the market breaks out of its flag, a further rise would be indicated. Should the lows be violated, a continuation of the intermediate-term downward trend is called for. In view of the current situation, it is a distinct possibility that traders will sit in the wings, awaiting a clearer delineation of the trend, and the market will move in a narrow trading range. The translation, I think, is if the market does not go up or down, it will remain unchanged. He must know how to understand the Dow Theory. I don't. And again, read A Random Walk Down Wall Street. Read One Up on Wall Street or A Random Walk Down Wall Street as your first book to read. Eventually, you're going to want to read The Intelligent Investor. Oh, by the way, in the book Random Walk Down Wall Street, Burton Malkiel took random stock, just made up random stock prices, and gave them to technical analysts who said, look at this, this is a such and such pattern, and it means the stock's going to explode or it's going to go down, quick sell. And Professor Malkiel said, but these are made up numbers. These are random numbers. No, you don't understand. Look at this. Even when we know, even when we're told that the data is completely random, we are heuristic. We superimpose patterns, even if we're told they ain't there. They just isn't there. Okay, so we're done, folks. We are done with stocks. I am so proud of you, and this gives me one last, well, actually, no, I'm going to ask you again throughout the semester. Think about a career in the stock market. Think about a career in the investment community. Think about a career in financial services. The industry is huge, and we need people. There's a ton of people ready to retire because what happened is in the 80s and 90s, it got harder and harder and harder to get into the business, literally. So now we're looking at a whole lot of people who are ready to retire, and there's not a whole lot of people coming up to take over. Plus, the industry knows, we need diversification. The world is diverse. I know some people are not happy with this. I understand fear and loathing and ignorance, but it doesn't mean that you should stop it from making money, and that's why the brokerage firms and the insurance companies and the mortgage brokers and the bankers and all the other dozens and dozens of types of companies in the investment services and financial services industry need minorities, women, bilingual, ex-military. They love ex-military. Why? It's very, very structured industry, very, very regulated, much regulation, and who better than people who thrived and lived in the military, which is also very regulated. So now, Typically, you don't have to. There's dozens of spots in the posts in the industry, dozens of positions. But typically, you start out as a broker's aide with an eye toward becoming a financial representative, a stockbroker. The legal term is registered representative. You are allowed to represent securities products, stocks, bonds, mutual funds, and the like. And they're going to do a background check, no shenanigans with other people's money. Now, here was the big deal. You got to pass the Series 7. Actually, if you just want to sell mutual funds, you can do Series 6, and that's what some people in the insurance industry do. But the Series 7 is difficult. It might be less now. It might be less than 6 hours. I really should go back and look. But they typically want you to take the Series 7, which is about 2 months of study in 1 to 2 hours a day. And then the Series 63 or the Series 66 are very similar. That's pretty easy. That's 2 weeks. It's an hour. Doesn't take very long. And before they've come up with this new exam, before you can take the Series 7, you've got to be sponsored by a brokerage firm. And many brokerage firms were reticent to hire someone until they knew they're going to pass the Series 7, because it's a big investment. They're going to train them. They're going to pay them a salary as a broker's assistant. And then the test itself is several $100, the background check and the like. And so for this reason, FINRA, the Financial Industry Regulatory Authority, now offers the Securities Industry Essential exam. Now it's a baby Series 7. And we've had at least one student take it and do really, really well. And he's doing out really well in the industry. At least he's the only one who came back and told us about it. It's $60 and you don't have to be sponsored. And the FINRA has the materials on their website. There are dozens of third-party people wanting to sell you their materials. There's practice exams. You take the practice exam over and over and over again. Now, the gentleman who took it, he actually came and spoke to our investment club, said he took 2 weeks to study for the SIE, but he studied 4 hours a day. Right? He basically crammed everything into 2 weeks. I recommend that people don't do that, just because it's not good for your health, first of all, and it's also an easy way to forget. After you take the exam, you forget a lot. If you spend an hour a day, 2 hours maybe for 2 months, 8 weeks, you should do fine. And we're going to get, at the end of the semester, we're going to look at some of the more trickier parts of the Series 7, the SIE, that has to do with options and shorting. We just talked about shorting and buying on margin. Those are very tricky. And those are the ones that tend to trip people up. And then they ask you a whole bunch of dumb questions that you would never, ever try to memorize. If you need that information, you just look it up. That's why we have computers. But they ask it for you, and then you'll quickly forget that information. But the rest of the material, folks, is what you're already learning. The material in this class is the foundation of the SIE Securities Industry Essentials exam and the Series 7. So you're already learning it. Think about it, folks. We want you to be awesome. The industry needs you. And I think we mentioned that the salaries are higher than the national average. Just think about it, dear students. And that is it. It's a long road. I told you it was a long march when we started stocks. Go back over these chapters again. Anytime you have time, you're going to be on the treadmill. You're going to be walking to the store, whatever, while you're commuting. Listen to them, because you are now an official guru, investment guru. You're going to speak with authority when your colleagues and your family members and your friends ask you about the thing that they've read about or heard about on the market, about the markets, and you're going to amaze them. I'm so proud of you. Because now, next week, we're ready for bonds. Boring bonds, stodgy bonds, reliable bonds. See ya. We're so proud of you. Keep up the great work.